safe to assume that you might prefer the value end of the market a lot more than the growth end of the market, or would you value that part of the market more, which is priced well as opposed to priced egregiously, even if it shows very strong growth?
So I think my sense is that the risk of going wrong is very high in overvalued companies, which I would put it this way, that you should look at how similar stocks were valued, say 10 years ago. I think maybe the consumer companies were valued at, say, around 25, 30 times earnings. Now they have reached some 60, 70, whatever, 50 times earnings. So there the risk is that, okay, will the market sustain these valuations? I think the risk is more on overvalued companies versus a historical perspective. Now, if the company is today, what we are buying into is value maybe 10 times, 12 times earnings, or maybe one-time price to book, etc. You could go wrong as far as whether the market may recognize them, may not recognize them. But in terms of multiple derating, I think a multiple derating is a far bigger risk to portfolios than earning. Earning obviously is there. So I would tend to look to invest in companies generally which are relatively under-owned and obviously give reasonable valuations with decent growth prospects. So I'm not in the camp to buy growth at any price or that kind of a thought process.
Got it. Okay, can I probe that point a little? Because I was just noting down, that's actually the headline for this conversation for me, that the risk of going wrong is very high in overvalued growth stories. Let me try and probe this a little. Let's say information technology, wherein companies and the broader end of the spectrum are saying that they will continue to grow 15, 20% for a better part of the next 5-6 years. A year or two could be here and there, but largely their growth seems intact. The valuations are not cheap. They've corrected quite strongly from the highs, but you could argue that some of these are not cheap. And there could be other sectors like that too. But I'm using this as an example. How do you approach this then?
Good question. I think, so there are two parts to it. One is obviously there has been a sharp 20-25% kind of corrections in many of these companies in the last, say, 30-40 days. So there is a possibility of, can there be a technical bounce up? Yes, there could be a possibility of a technical bounce. But having said that, I think on a valuations perspective, from a historical averages, the way these companies have been valued, they are quoting at a reasonably high premium to historical averages. And at one level, most of our IT companies are US facing. 70-80% of their businesses come from US facing. Currently, when we talk to most of the companies, all the businesses, order flows, etc., everything seems to be strong. But at one level, we are so fearful of a soft landing or a recession in the US 12 months, 18 months, 24 months down the line. Then what makes us think that the same order book which is so strong today, a few orders can always get cancelled. And when these things, and when you have earnings cut, and then there will be a multiple derating also. So I would be very, very careful and wary of investing in IT companies today. A, because of the high valuations, and B, because I don't know how the US economy is expected to fare in the wake of rising interest rates and the need to have a soft landing or a recession, how it is going to finally pan out. But that is the risk. So IT companies, I mean, that's the question that is there in my mind, that are we going to get into a trap? Plus, no pricing power. Look at the margin guidance most of these companies are talking about. They all guided on a lower margins.
Yeah.
So where is everything else is right, going right for the companies. But my fear is on the order book itself. What prevents US companies to say, okay, my business is under pressure, etc., etc. I want to just shift my IT programs maybe by 2-3 quarters or 1 year. Then what happens?